All right, yo, so check this out. So I wanted to show you a little something that I do when I'm trading stocks and things in order to protect some assets, take some profit, but still continue to be in a trade that I think is going to continue to be profitable. So this is Take-Two Interactive. They're the creators of Grand Theft Auto. They with the publisher Rockstar Games, and absolutely fantastic stock. This was the first stock I ever bought. I got some other lots and whatever, but so check this out. So right now, they finally broke out of some lows that they were tending with and stuck in a pattern and whatever, and they finally broke out. GTA 6 is supposed to come out next year. I'm a little bit profitable, but I'm looking to be a lot more profitable this year. So what I would do is, so for example, right now, I can take out some profit. Like let's say, for example, I just sold everything. I made my little 2-3 grand or whatever. This is the trading ladder. I love the trading ladder. It allows me to basically look at the bid and the ask. So these are the people who are looking to buy. These are the people who are looking. I'm sorry. These are the people who are looking to buy. These are the people who are looking to sell. You can see they have their little orders in right there at these different prices. This highlighted one is the last price, so you can see the spread between what they're trying to buy at, what they're trying to sell at. So not a lot of liquidity in this particular stock right now, which is common. It's a long-term play anyway, whatever. So let's say that I came in here, and what I really love about the trading ladder is when I'm day trading, where I need to make moves quickly, buying and selling. Sometimes I can make like 12 trades in a day, making money going up and down. So I can come in here and I can put in how much I want in my order. I can click auto send, which is just going to automatically trigger the order. So I can just come in here literally and be like, blip, click a button, and I can sell. Click a button and I can buy, or put in the order and it'll wait until it gets sold or bought. So imagine that I just went ahead and I just sold all my shares. I made my little 2-3 grand profit or whatever, right? So then I could come to the trading ladder. So this is the options. I'm sorry, the options chain. This is the options chain, and let's see. I'm gonna scroll down to how far does this go? It goes all the way to January 27. January 2027, January 15th, 2027. So I don't need to go that far out. I'm going to look at, let's just say a year. So GTA 6 is coming out next year. I anticipate the stock to go boom when it finally does. So let's look at the options for basically the end of 2025. So we've got September and then January 26th. So fine, we're going to look at January 26th. So here we've got the 185 strike price. So that's the price of the stock. And we'd be essentially buying a contract. If we buy one contract reflects 100 shares. So at $26 per share for the contract, we'd be paying $2,600 in order to have a contract with a strike price of 185 for 100 shares, one contract reflecting 100 shares, meaning that I am buying the option to buy these shares at $185 between now and the expiration date of January 16th, 2026. So if we look back at my chart, I'm basically about $2,600 profit. So what that means is, let's say I sold my shares. I come in here and I take that profit and I buy one contract. So now I've got all my money back. I took my profit and I made this trade. So it's basically a free trade. But I'm now holding a contract that gives me the right or the option to buy the shares at 185 between now and the expiration date, no matter what the price of the stock is. So if the price goes up to 270, I can buy it at 185 anytime I like between the expiration, about before the expiration period. But here's the kicker. Let's say, for example, we go all the way back here and we look at this option for 185, the current one, well, around November, later in the week or next week or 2 weeks from now. $185 strike, one contract on November, expiring on November 29th, 2024, is only $1.54. So imagine that you had a contract that then was in the money. So for example, in the money meaning someone here bought these contracts. Someone bought a contract at 115 bucks that expires. Who knows when they bought it? Could have been a year ago. They could have bought it for $1. But now it's worth $68. This is way deep in the money. So this is worth $68. So what happens is this contract I might buy that expires in a year from now, if the price goes up, let's say it does go up to 270, well, guess what? Now this contract that I bought is going to be worth a lot more money than the original 2,600 bucks or whatever I paid for it. So instead of even buying the shares, you just sell the options. You sell the options, you make your cash, and you do whatever. You don't even have to wind up buying the actual shares in order to actually profit from it. So anyway, there you go. What we're talking about here is basically buying call options, but you can also sell options, and you can also buy puts and sell puts, which are trades that you can do to bet on the downside. So if you think a stock is going to go down, you can utilize options to protect your assets as well as to capitalize on and make money on the market going down as well. And let me tell you, it's a special kind of feeling when everybody's fucking crying and losing their shit because the market's taking a downturn, and you're sitting there like a pig in mud, just rolling around in it, loving it, making a ton of money while everyone's crying. I'm sorry. It's just absolutely delicious. It just is. But anyway, so yeah, there you go. Till next time.